So hello, everyone. My name is Paulo Aguilar, Director of Capital Markets here with Revitate Cherry Tree, and I'm happy to be joined today by Chris Marsh, Senior Operating Partner of Revitate Cherry Tree, to talk about our multifamily housing fund and specifically the focus of the Midwest markets that we're targeting in the country. So Chris, thanks for joining us today.
Thank you, Paulo.
Absolutely. So let's just jump right into it. So Revitate Cherry Tree is primarily paying attention to multifamily workforce housing communities, but specific to a region of the country, the Midwest. And you've called it the I-70 Triangle. So talk to us a little bit more about the I-70 Triangle in this region.
Sure. I think it's fair to say our workforce housing investment strategy certainly enjoys the full broad focus that encompasses growth cities and MSAs throughout the Midwest. But as you're alluding, we do especially like the cities that form what we've dubbed this sort of I-70 triangle. And if you can imagine, that's a geography that can be approximately defined, sort of going west to east as Kansas City to Indianapolis, and then on again to Columbus, Ohio, all very much dotted along the I-70, and then kind of headed southwest from there on what I think is the 71, I believe, from Columbus to Cincinnati, Ohio, and then on to Louisville, Kentucky, then back to St. Louis, Missouri, and then I think it's the I-64 to conclude the triangle back on the I-70 to Kansas City. So it's a very approximate triangle. And again, our endeavors aren't limited to these cities, but it has been helpful to think about them in sort of a hub and spoke analogy. And these cities serve as kind of the hub of our focus in terms of providing sort of concentration, which extend via spokes to define kind of spheres of interest around them in other growth cities, which might include, for example, staying with Ohio, Dayton, Ohio, Lexington, to the east of the geography, then maybe Des Moines, Iowa, Omaha and Lincoln, Nebraska, to the northwest, and Topeka and Wichita, to the west of Kansas City. So it's a large geography, but hopefully that gives it some broad definition.
So what specific trends are you seeing in this sort of I-70 triangle that you think that's attractive, that merits you to really focus on this for the fund and its investors?
Well, we start, we're data driven, we're top down in everything we do. And so, long-term population growth trends are what we look for, and ideally significantly ahead of the national average for the past decade or more. So established trends which are set to continue. It may surprise some to learn, for example, that Des Moines, Iowa has enjoyed almost a 20% population growth over the past 10, 12 years versus a national average of 8%. So these population trends, we like them because they tend to be invited by employment growth, by job growth, which is something we very much look closely at, in the apartment sector. Headline job growth and diversity in the types of jobs that are being created are major draws for driving apartment demand. And, just talking more broadly about the Midwest, historically agriculture and manufacturing have dominated in the Midwest. And while these vital industries do continue to this day, they have been accompanied by real job growth in an array of sectors, including healthcare, including financial services, government, education, technology. And so we like that diversity of job growth as well. So that's the first trend. The second trend that we think is set to continue is this sort of genuine flight to affordability. Residents in this sort of I-70 triangle that we described enjoy a cost of living and hence a greater purchasing power, which ultimately translates to quality of life. The cost of living in Cincinnati, for example, is around half of what it is in New York City. The cost of renting an apartment in Kansas City, Missouri is around a third of what it costs in Los Angeles. This matters, and it's going to matter more as we move forward, especially when the workforce is enjoying more and more mobility in this sort of post-COVID era. So all of the cities in our target geography, and the ones I've referenced, certainly rank below the national median for cost of living, which has been a catalyst for new residents and employers alike, of course, as they chase those skills. So as families continue to get priced out of high cost of living coastal cities, certainly, and others, we believe the Midwest will continue to be a net beneficiary of outsized housing demand over the long term.
Hmm. Yeah, it sounds like there's a lot of strong fundamentals that are taking place in this region of the country, but despite these, promising trends, it seems like a lot of the attention is being really focused on the Sun Belt markets, coastal markets, right? They're grabbing more of the attention from investors, retail, institutional, and also the media. So like, what are your thoughts surrounding, that statement alone? And, what are you seeing on the ground from what you're doing?
Yeah, well, I think that's fair. The Sun Belt phenomenon, especially, is well documented, certainly being a significant driver of apartment investment over the past few years, most notably in the value add space. However, as longer term investors in real estate, then certainly than your typical value add investor, we're more interested in highly stable asset classes that have stood the test of time and are not as susceptible to things like, debt pricing shifts, for example, that we've seen this year, affordability challenges that attend that, and of course, recessionary threats. With a couple of exceptions, I think to your point, the 15 top publicly traded REITs have little or no holdings in the Midwest. I think there's two exceptions to that. So apartment sales volumes in the Midwest are lower than coastal cities, certainly, but we like this historic lack of institutional focus on the markets because it actually makes for a very efficiently priced market. When it comes to acquisition pricing, there are signs that's changing. Folks are waking up. These are no longer the flyover states, I can assure you. And certainly as an investor over the past decade or more, it's very clear that others are waking up to the opportunity, especially when it comes to larger portfolio sales. But we think the opportunities for investing in workforce housing in the Midwest, for those investors sort of willing to look around the corner, if you like, are significant and carry often overlooked value.
Switching gears to the fund, right? Revitate Cherry Tree.
Yeah.
What are some of the benefits that you think may garner from investing in that fund specifically for Midwest multifamily workforce housing? What are your thoughts on that?
So I think a key benefit, and hopefully it's viewed that way, is portfolio diversification. When we believe that when you take a sub-institutional asset class or one that historically has been regarded as such, and you apply a level of institutional operational know-how with the expert asset management capability that we bring, you can create significant value, and especially when that's done at scale. A second is, recession hedge. We're not sure where we're going, of course, but there's always a recession in the future. Where do investors allocate capital in times of recession? I can tell you the workforce housing, providing as it does, fundamental human need. It provides shelter, a home at an attainable price for working American families in a time of historic housing shortage and unaffordability, is about as close to recession-proof, certainly in the real estate space, that I've experienced, having spent 30 years in all asset classes. And I think a third benefit, if you like, is easier access to attractively, or might I just say realistically priced deals, or in other words, an asset market that is working very efficiently. Workforce housing has enjoyed strong and steady rent growth for decades, and it's also enjoyed corresponding increases in asset values. That's true. However, as a team, very actively engaged in this space, I can tell you those valuations are based on fundamentals. They are based on past and current cash flow trends, not some extrapolated or exaggerated view of what the future may hold. They're based on current credit product pricing and conditions, and not some more esoteric or creative debt product that's been, oftentimes supporting certain asset strategies for years, which dries up when credit spreads explode. So we believe, these fundamentals provide for inherently stable investment opportunity in times of, real instability such as these.
Currently, you have 5 assets in the portfolio where they all kind of fall in that I-70 triangle. So talk to us a little bit about how those assets are performing currently.
Yeah, so yeah, Revitate Cherry Tree purchased 3 assets toward the end of last year in Kansas City. And in the past few months have acquired another 2 assets. These are in Indiana for a total of about $100 million invested to date for 750 units. The fund strategy targets, conservatively, we believe, a cash flow to investors of 6% of their invested capital per year, and an overall 11 to 13% IRR over the 7-year life of the fund. I'm happy to report that our strategy is working well. We're currently well ahead of that goal with an average cash on cash across all 5 assets of 8% to date. I can add that our assets are 95% occupied, and the retention rate, which I particularly pay attention to, and that's almost 70%. And I can tell you, having spent a long time in this industry, the industry norm's around 50, 55, and if you can do better, you're doing very well. So, our plan over the long term is to continue to surprise only to the upside. And thus far, I have to report we're well on track to do just that.
Well, that's excellent news, Chris. I want to thank you for the time today. And for the folks who are interested in learning a little bit more about Revitate Cherry Tree and this strategy in the Midwest workforce housing, feel free to visit our website at rev-ct.com. And again, Chris, thanks again, and I'll see you around next time.
My pleasure, Paulo. Stay well.